Everyone wants a steady income in retirement, that comfortable, predictable paycheck without selling shares. It's a reasonable goal, but the way most people try to get there, by chasing the highest yield or only buying growth stocks, usually creates new problems. Today I'll walk you through a realistic 6-part portfolio designed to produce reliable income while managing risk. I'm not promising any magic checks like some of the other people on YouTube. This is a practical framework, 6 components, why each matters, typical allocation ideas, and common mistakes to avoid. With that said, let's see what the perfect mix looks like. When most people think about living off their investments in retirement, they hear about the so-called 4% rule. The idea is you sell about 4% of your portfolio every year and hope it lasts for 25 or 30 years. Sounds reasonable, right? But no one can be sure about this, because the way the economy is going right now, we don't know if the market is going to crash tomorrow. So instead of relying on selling pieces of your portfolio, the newer and smarter approach is to build a portfolio that can actually pay you through dividends and income streams while still keeping its value intact. That way, your investments act more like a steady paycheck than a savings account you're draining. But here's the most important part. When people get to know about this dividends, they chase the highest yield they can find. On the surface, that looks great. Big dividend checks rolling in. But under the hood, the portfolio's NAV, or net asset value, is shrinking. It's like driving a car with a full tank of gas, but every mile you drive, the engine is breaking down a little more. Eventually, the car won't move, no matter how much gas you have. On the other extreme, some people go all in on growth stocks, companies like Tesla or Amazon, that reinvest profits instead of paying dividends. Sure, the account balance might look amazing on paper, but when it comes time to pay the bills, you'll have to sell shares. That means your income depends on market timing, and we know that's risky. The sweet spot is balance, combining reliable dividend payers with growth companies. Dividends give you cash flow today, and growth keeps that income rising tomorrow, so inflation doesn't eat it away. Coca-Cola, for example, has been raising its dividend for decades, while a company like Microsoft grows earnings fast enough to boost future payouts. You need both. So think of your retirement portfolio like a pizza. You don't want 6 plain slices of cheese. You want different toppings, different flavors working together to make a complete meal. In our case, that means 6 different components, each with its own role. Our first fund is Maggie. This is an ETF made up of the biggest and most widely held tech companies in the market. It has had a 7.31% of year-to-date return, which is nice. But what makes this unique for a retirement income plan is how it pays. Unlike most growth-heavy ETFs that reinvest or pay tiny dividends, Maggie is structured to deliver weekly payouts. Add those up, and you're getting about $1.44 per share each month. On a percentage basis, that works out to a yield of roughly 30%. And yes, that's extremely high. But what's just as important is how it pays. Distributions have been fairly flat and stable instead of swinging wildly. That makes it much easier to plan your income around. Since it has a 7.31% NAV growth, that brings us to a 37.95% total growth. The key takeaway here is this. Maggie gives you exposure to big, liquid companies, and it translates that into consistent cash flow, something most tech investments don't offer. So instead of having to sell shares of Amazon or Microsoft to generate income, you're getting regular distributions while still holding the stocks. This makes Maggie the growth engine of the portfolio: high yield, consistent payouts, and exposure to some of the strongest companies in the market. But remember, what we are looking for is balance. And that's exactly what we're going to do with the second one. Next up is UT, the Reeves Utility Income Fund. This one takes the opposite role of Maggie. Instead of fast growth, it's built for steady income. Here's why it fits a retirement portfolio. UTG invests in essential services like power, water, gas, and internet. These are the things people and businesses keep paying for no matter what the economy is doing. That stability shows up in the fund's track record. Currently, UTG pays about 20 cents per share and has a 6.3% yield. I know that's not that high, but it has been steady ever since it started paying. So the reliable factor is a huge consideration when choosing this. Unlike some high-yield funds, this hasn't been cutting distributions every time the market wobbles. On top of that, UTG's net asset value has grown nearly 19% over time. Think of UTG as the steady layer in the portfolio, and that's exactly what most retirees need. Consistent cash flow paired with slow and steady capital appreciation. So, with Maggie, you've got your growth engine. With UTG, you've got your safety net, the steady paycheck side of the portfolio. Okay, we've got the safe side covered. Let's add a bit of spice to this mix. Cause next up we got BTCI, the Bitcoin Income ETF. This fund is different from UTG or MAGY. Instead of making money with the tech sector or utilities, BTCI doesn't exactly focus on Bitcoin's price change to make money. It holds Bitcoin, but also does smart strategies to generate extra income, which it pays out to shareholders every month. So you don't need to worry about Bitcoin's price. It still gives you consistent cash. Right now, BTCI pays about $1.45 per share per month, which works out to roughly a 25% dividend yield. On top of that, the fund has seen around 22% growth in net asset value over time. That's much higher than most traditional income funds. Of course, it is riskier. Bitcoin can be volatile, and the income from covered calls can go up or down, depending on the market. But for a small part of a retirement portfolio, it's a way to capture higher yields and potential growth without having to manage crypto yourself. So, yes, it's riskier, but the numbers make it an attractive option for the portion of your portfolio that can handle more risk. Not everyone is comfortable with crypto, and that's fine. That's why our next fund brings us back to the core of the US economy. But before we get to that, if you're finding this helpful so far, make sure to like this video. It really helps me know what content to make, and hit subscribe for more videos like this. Now let's move to SPYI, the S&P 500 Income ETF. This fund is built on the 500 largest companies in the US, the kind of businesses that are everywhere. What makes SPYI important for a retirement portfolio is the combination of income and stability. It pays about 50 cents per share each month, which adds up to roughly a 12% yield per year. That's a strong, reliable source of cash flow you can count on. And because it covers large, established companies, it's much less volatile than smaller or more speculative stocks. It has a NAV growth of 1.1%, which is not much, but what's important it's not shrinking. And that brings us to a total return of 13.1%. Think of it as the backbone of your portfolio. It's the part that keeps everything steady while other slices chase higher yields or growth. You get regular dividends, plus the potential for long-term growth as these companies keep earning and expanding over time. But of course, a portfolio can't rely only on big, slow-growing companies. What about the smaller, scrappier companies? The ones with more room to grow and take off. That's exactly where our next slice comes in, the Russell 2000. Next, let's talk about IWMI, the Russell 2000 ETF. This fund focuses on small-cap companies, the smaller, scrappier businesses that often have room to grow much faster than the large companies in the S&P 500. Since these businesses are still in expansion mode, still finding new markets, they can give a higher growth potential for your portfolio. Including small caps adds diversity. If your portfolio only had big, stable companies, a downturn in one sector could hit hard. Small cap exposure spreads that risk across a wider set of companies. It's like adding a few dynamic players to a balanced team. They bring energy and opportunity without taking over the whole game. IWMI is not just about growth. It also generates solid income, paying roughly 14.6% in dividends. What's notable is that even when the net asset value dips due to market swings, the fund continues to deliver cash flow. That's important for retirement income because you're looking for reliable payouts, not just paper gains. Another advantage is that the fund is generally tax efficient, helping you keep more of what you earn. Think of IWMI as the energetic slice of the portfolio. It balances out the slower, larger companies with smaller, faster growing ones, and still contributes meaningful income each month. So now, with IWMI included, your portfolio has large caps, small caps, utilities, tech, and even Bitcoin. You've got stability, yield, and slow growth all working together. But there's still one piece missing, and that's forward-looking growth. And that's where the NASDAQ 100 comes in, which is where we'll focus our final slice. Our final slice is QQI, the NASDAQ 100 Income ETF. This fund gives you exposure to the 100 largest non-financial companies listed on the NASDAQ, mostly big tech and other innovators. Think of it as the part of the portfolio that keeps you connected to tomorrow's potential winners. QQI pays around 13.9% in dividends, while also showing about 3.4% growth in net asset value. The payouts are fairly consistent, even though share prices can experience small dips along the way. That combination, where you get a steady income and moderate growth, makes it a strong complement to the other funds in the portfolio. The total return is 17.3%. Now, Some might ask why you should include the NASDAQ 100 if there's nothing really special about it. Well, it's about capturing companies that are likely to drive innovation and earnings in the years ahead, while still generating reliable income for your retirement. So, Triple QI rounds out the 6 slices of the portfolio. All of these deliver a mix of yield and stability. This fund represents the forward-looking part of your retirement plan, the companies that could be tomorrow's big winners, while still keeping income rolling in. Okay, now there are the 6 slices. Now, let's quickly recap what each of those does in the grand scheme of things. MAGGI, tech growth with weekly payouts. UTG, utilities, providing steady, reliable income and safety. BTCI, higher risk, higher yield cash flow. SPYI, backbone of stability and predictable dividends. IWMI, cap growth plus income, adds diversity. Triple Q, income plus forward-looking growth. Each fund has a purpose, and together they give you diversified, reliable income and long-term growth. This is a portfolio designed to work for retirement without chasing hype. If you found this video helpful, go ahead and tap the like button. It really helps me know what content you want more of. And don't forget to subscribe for more videos like this. And here's the question of the day. If you had to choose just one, would you rather have a portfolio that pays you steady income every month, or one that grows big over time but pays less along the way? Please give your answer below. I love to read your opinions.